All right, welcome back to Yahoo Finance Live on this Thursday morning. We are about 2 minutes away from the opening bell. Futures pointing to a higher open as things in the market calm down just a bit after a frenetic couple of weeks. Joining us now to talk about everything going on in the markets these days is Jeff Kleintop. He is the Chief Global Investment Strategist over at Charles Schwab. Jeff, it's always great to get your thoughts. I'd love to start with sentiment and sort of how we finished 2020, where investors were quite enthusiastic about a number of potential catalysts in the market. Some of them came through, some of them didn't. Obviously, a lot of enthusiasm still in the market. Has that changed how you're thinking about the setup as we kind of ease our way into 2021?
Well, we can measure sentiment a lot of different ways, but almost no matter how you measure it, in the U.S., it's elevated. And we can look at that in speculative activity in certain stocks. We can look at that in responses to surveys. We can look at that evaluation. So many different ways, flows, really looks optimistic. However, that's not the case if you look overseas. If you look, for example, at the UK market or Europe or even in Asia, Japan, we're not seeing the same level of optimism, of speculation, none of that, nor valuation. So I think there are opportunities there that investors have been overlooking after 12 years of U.S. outperformance. Now with the start of a new cycle, they may want to begin to look overseas.
Hey, Jeff, it's Julie here. And this is something you pointed out in a recent note that there's been a lot of table pounding on diversification as of late, I feel like, on the part of strategists like yourself. And usually that diversification is talking about as sort of asset diversification, right? That you want to own different types of assets. You paint more of a picture as well of geographic diversification as you're talking about. I mean, what do your numbers show in terms of what kind of ownership people tend to have in their home countries versus abroad when it comes to stocks?
It's a great question. So many investors just focus on their home market, really wherever they live. Here in the U.S., most investors' portfolios, they consist of about 75% of their equities in domestic stocks, U.S. companies. But that's true in Greece. Greek investors put 75% of their money in Greek stocks. That sounds like a good idea. I don't think so. And what it means is you get a lot of sector concentration in your portfolio. For example, German stocks, they all together collectively behave like an auto ETF. In Japan, they behave like a financials ETF. In Canada, like an energy ETF. And in the US, like a tech ETF. Now, that's been great for the last 10 or 12 years, but we know there are periods where tech isn't the only place to be. And we could be on the start of one of those rotations into more of a value-oriented and a broader market, meaning that maybe looking at broader diversification may finally make some sense.
Jeff, does playing U.S. small caps make sense to you right now, just given where we are in stimulus talks? They appear to be moving forward, and by moving forward means consumers might be getting another $1,400 check.
Traditionally, this is the time you would want to invest in small company stocks as the economy comes back and as capital conditions remain favorable. But we're a little concerned with a lot of the zombie companies that are, barely able to make payrolls, barely able to make their debt payments, even at these low rates. There's a lot of that in the small cap universe. So we're neutral to small caps right now, even though normally at this point in the cycle you would expect strong outperformance.
Hey, Jeff, we got jobless claims this morning, 779,000. It's the lowest since late November. We've seen several weeks of declines now. It's lower than expected, also setting up for tomorrow's jobs report. So, even though the U.S. market has performed incredibly well, given some obstacles, some of those signs, like the jobs report, maybe are they going to be pointing in the right direction for continued outperformance here?
This is a really interesting point. The data hasn't been great, but it's been better than expected pretty consistently here in the US, also in Japan, and even in Europe. I mean, we talk about this double dip in Europe, and indeed some of the countries in Europe did see negative GDP in the fourth quarter, just reported this past week. But what we're seeing is the data is coming in even better than expected, even to a wider degree in Europe than in the US. So yeah, across the board globally, even though we're in this sort of second slowdown, double dip, if you want to call it that, the data comes in better than expected, and markets key off of that, analysts key off of that when it comes to earnings expectations. So with better than expected economic data, rising earnings forecasts, yeah, I think we can continue to see gains, though the relative outperformance may be in those markets with lower valuations, meaning overseas.
All right, Jeffrey Kleintop is the Chief Global Investment Strategist over at Charles Schwab. Jeff, always great to get your thoughts. Thanks so much for joining the show this morning. I know that we'll talk soon.
Thanks for having me.